Welcome to The Explainer. Today we're digging into a massive $9 million bet, and it's a bet that flies in the face of all the bad news swirling around one of the biggest brands on the planet, Nike. So let's just put this number out there first. $9 million. That's not a typo. That is the size of one single bet that an anonymous institutional investor, what we call a whale, just placed on Nike. And that's the real head-scratcher, isn't it? I mean, why would anyone, let alone a huge whale, drop $9 million on a stock that just got hammered? We're talking a 10% drop after a really, really bad earnings report. To figure this out, we've got to peel back the layers and think like a real contrarian. Okay, so here's where things get really interesting. This wasn't just some big shot buying up a ton of stock. Nope. This whale used a much more sophisticated tool. Options. And by doing that, they sent a very specific, very loud signal to the market. They're basically saying, hey, at a certain price, we believe Nike is an absolute fortress.
So what's the secret weapon here? It's something called selling a put option. Now don't let the name scare you. All it really means is this. They got paid cash right up front just for promising to buy Nike's stock at a lower price later on. Think of it as a bet that the stock has pretty much hit rock bottom.
Let's get into the nitty-gritty of this trade. So they sold 2,000 of these put contracts. That obligates them to buy 200,000 shares of Nike stock at exactly $45 a share. And they have to be ready to do that anytime in the next year and a half. The best part? For taking on that obligation, they pocketed a cool $180,000 instantly. Okay, and this is the really brilliant part of the whole strategy. Right now, Nike's trading around, $58? Well, this trade gives the whale a huge cushion. Once you factor in that cash premium they already collected, the stock has to fall nearly another 25% from its already beaten down price before they even start to see a single penny of loss. That's a massive margin of safety. All right, so the magic number is $45. But why? What's so special about $45? Well, the answer isn't on some daily stock chart or a hot take on TV. It's buried deep in the fundamentals of the business itself. Essentially, this whale is drawing a line in the sand at $45. The whole thesis is that at that price point, Nike completely transforms. It's no longer about chasing hypergrowth. It becomes a deep value play. An asset that is just screamingly cheap, something you just can't ignore. And you can see this playing out in the valuation. I mean, just look at these numbers. Historically, people have been willing to pay a premium for Nike, a price-to-earnings ratio over 36. But if the stock hits the whale's price of $45, that PE ratio shrinks all the way down to 23. That's so far below its average, it's like a giant blinking sign that says value. But wait, there's more. It's not just about the PE ratio. There's another safety net here, and it's just simple math. See, as a stock's price goes down, its dividend yield goes up. And at $45 a share, Nike's dividend would suddenly look really attractive, almost 4%. That's going to bring a whole new crowd of investors to the table, people looking for income, and their buying is going to create a solid floor of support right around that $45 mark. All right, but let's be real. To make a smart bet, you have to know why everyone else thinks you're crazy. So let's flip the coin and look at the bear case. Why is the rest of the market so spooked about Nike right now? The number one boogeyman is China. And yeah, a 17% drop in sales there, that's a terrifying headline. But here's the contrarian view. The whale is betting that all that fear, all that worst-case scenario thinking, is already baked into the stock price. At $45, the bet isn't that China has to stage some miraculous recovery. It just has to stop getting worse. Okay, fear number 2. Nike has lost its cool. It's lost its innovation mojo. You've got these newer, hungrier brands like On and Hoka that are just growing at an insane pace. They're stealing market share and making Nike look, like a slow old giant. But the whale's counter-argument is simple: scale. We're talking more than $4 billion a year on R&D and marketing alone. That's a financial fortress, a moat that these smaller competitors just can't cross. And let's not forget, we've seen this movie before, right? Reebok, Adidas, lots of brands have come for the crown, but Nike is still king. So when you put it all together, what do you get? It's really a classic investing playbook. You're taking the market's panic and fear, and you're using it as a long-term opportunity. You're trading their anxiety for your patience. Just check out this comparison. Let's imagine a total nightmare scenario. Nike collapses to $35. If you just bought the stock today, you're down more than $23 a share. Ouch. But our whale? They're forced to buy at their pre-agreed price, so their loss is less than half that amount. That's what a real margin of safety looks like in action. So you see, this is so much more than a simple bet that Nike stock is going to bounce back. This is a $9 million declaration. It's saying that below $45, the fundamental value of this company creates a floor so strong, it's practically unbreakable. And this whole setup allows the whale to do something that the source calls paid patience. And I just love that phrase. Think about it. They're literally getting paid from the option premium, from interest, to just sit back and wait. They're collecting income while they wait for everyone else to calm down and see the value that they already see. When you really get down to it, this whole trade is just a masterclass in ignoring the short-term noise. While the rest of the market is chasing the next big thing, this is a huge bet on the last big thing. It's a bet that the swoosh, even when it's taken a few hits, isn't going anywhere. And that really leaves us with one final thought, doesn't it? In this crazy market of high-speed trading and constant anxiety, maybe, just maybe, the last true competitive advantage isn't a faster computer or a better algorithm. Maybe it's just the willingness to be patient.